morning, everybody. My name is Paul Ruiz, Director of Professional Development here at the Entrust Group, and welcome to our webinar today. I know a lot of you folks have been affected by the recent situation right now in our current landscape, so we appreciate you attending today's webinar. We are not going to be able to cover everything about taxation in 2020, but we will definitely focus on its effects on retirement plans. Before we get started, the Entrust Group does not provide investment advice or endorse any products. All information materials are purely for educational purposes only. All parties are encouraged to consult with their practitioners, such as your attorneys, accountants, and financial advisors, before entering any type of investment or any type of transaction. As well as if you have any further questions in regards to taxation, please consult with your competent tax advisor. But hopefully, the information that we present to you today will raise up enough questions for you or raise awareness so that you can make an informed decision going forward. The agenda for today, we'll briefly talk about who the Entrust Group is, what is a self-directed IRA, and which is what our niche is in the marketplace. We are a self-directed platform provider. We don't offer any investments, but we do offer the platform to allow for the retirement plan holder, whether it be an IRA or a qualified retirement plan or an employer-sponsored plan, such as your SEP plan or simple plan. Contributions to these accounts are contributed to a platform called a self-directed platform. That platform allows the IRA holder to choose the investment that they choose to hold under a retirement plan, like other providers who dictate what investments they offer. The Entrust Group does not offer any investments. In other words, we allow for the IRA holder, assuming of course it's allowable under law, to hold just about anything that's allowable under law to be held under their retirement plan. In other words, we can custody those particular types of investments under your retirement plan. We'll talk about the benefits of self-direction, and then last but not least, we will dive into the tax deadline, what is the difference between a traditional and a Roth IRA, and contribution basics, as well as tips to reduce taxable income using a retirement plan. And lastly, we are going to talk about quickly how you get started by opening up an account at the Entrust Group, and then we'll open up the phone lines for any questions you may have. The presentation material will last approximately, we shoot for about 45 minutes long, and then we're going to open up the phones for any questions you may have in regards to the materials presented. Okay. A little bit about the Entrust Group. Again, we are a self-directed IRA, and not just IRA, but employer-sponsored plan platform provider. When I say employer-sponsored plans, I'm talking about your individual 401k plans, your SEP plans, as well as your simple plans. We've been around for nearly 40 years. In other words, we've been in this particular market, offering this type of services going on almost 40 years to the industry. Although this platform has been available to the taxpayers in the United States, not a whole lot of people were aware that you can actually invest in investments beyond stocks, bonds, mutual funds, or maybe even CDs or money market accounts. Some of our clients invest in real estate, precious metals, notes, private placements, just to name a few of those types of investments that are typically not welcomed or held in other IRA providers. We have approximately 22,000 plus accounts, as well as transact over $3.6 billion of investment assets within the IRAs that we have. The thing that's different between us and some of the self-directed administrators is that you have a service contact, in other words, you have an individual you can actually speak with in our organization. We have a live customer service department, as well as brick and mortar offices in strategic locations of the United States. But if you like electronic as well, then we also are capable of providing forms as well as account establishment online. About the Entrust Group, our educational offerings do not just provide education to investors, but we also educate the industry. In other words, our presentations are available for CE credits for some of your retirement plan professionals, as well as other investment professionals, tax professionals, and For example, real estate professionals, real estate brokers can get CE credit from some of the courses that we offer. Included but not limited to are your CFP board, where our courses are approved for the Certified Financial Planner. We're an approved continuing education provider for the Internal Revenue Service, the National Association of State Boards of Accountancy. As you can see, there are a numerous amount of destinations that actually use our courses for continuing education credits. We also provide local webinars or seminars on site. If there are enough professionals that are needing continuing education, in other words, if you have a bunch of realtors, a group of realtors that are wanting to CE credits, so we can actually fly out to a certain location and provide a presentation that would be eligible for continuing education credits for some of the licenses as well as designations individuals have. One of the things that makes it different again is that we educate the industry. We have what we call our IRA Academy, which is approved by the American Banking Association Professional Certifications, which is one of their designations, called the Certified IRA Service Professional. Our IRA Academy is designed to satisfy that curriculum for individuals in the industry wanting to acquire the Certified IRA Services Professional designation. So not only do we offer a platform, but we also offer education as one of our major tenets and values as an organization. Now, a self-directed IRA, again, a self-directed IRA is not a type of IRA. It's a platform. It's a platform that allows for individuals with traditional IRAs, Roth IRAs, SEP IRAs, simple IRAs, individual 401k plans to hold investments beyond your stocks, bonds, and mutual funds. It is still regulated by the Internal Revenue Code because it's not any different than any retirement plan. It just so happens that our platform allows, again, the investor to hold any type of investment allowable under law under the retirement plan, which is broader than what some financial institutions allow. Because again, we don't offer any investments. We offer the administration as well as a platform to hold those particular types of investments. Now, with that said, the broader array of investments available out there allows for an individual to further diversify their portfolio. In other words, if you really want a diversified portfolio beyond stocks, bonds, and mutual funds, there are other types of investments that you, the IRA holder or retirement plan holder, can source out, vet out with your competent tax, legal, or investment advisor, and hold that under your retirement plan. In other words, you can diversify your portfolio further. As a matter of fact, right now, with the market not being as stable as it is, some individuals are investing in gold, as an example. If that's your risk tolerance or that's your liking, there are opportunities to invest in precious metals under a retirement plan. Or if you like real estate, in other words, let's say you're about ready to retire and you cannot handle another market crash or another stock market crash, and you're choosing to invest, as an example, in an apartment complex wherein the rental income is actually not taxed, because the rental income that goes into a retirement plan is tax deferred, well, then this is the platform of your interest group, but one of the retirement plan holder, your sponsor. Again, it allows you to source an investment to do for the IRA holder and not the interest group. But we will have payments so that it preserves its tax advantage. The first tax, it allows for your retirement plan to grow a lot faster. Benefits of self-direction, again, in a nutshell, you can take your control or investment choices, diversify, portfolio held under a retirement plan. In other words, in some cases, invest in what you know and understand, opposed to investments that are being offered to you. Do not have never even met any of the fund managers, some of that retirement plans are invested in. In other words, if you're for example, real estate professional, maybe something for you to consider. in some of the retirement plans, the contributions may be tax deductible. And last but not least, the earnings do grow tax deferred. In other words, it's not going to be taxed until you take a distribution. That's why you cannot hold your investments under a retirement plan. Somebody has to take custody of that for you, and that's what the Entrust group provides. We custody the investments so that it doesn't get taxed, but when you do take a distribution, it could be taxed. Now, there's another type of retirement plan called a Roth IRA, wherein not only do the earnings grow tax deferred, but eventually those earnings may be distributed tax-free. And those are the types of things we're going to cover later on in this particular course. All right. Now, first, let's take a look at the tax deadline. Why is that significant? Because the tax return due date of April 15 is typically when retirement plan contributions are due. All right. Retirement plan contributions are typically due by the individual's tax return due date. For C Corps and sole proprietors, it is April 15th, as well as individuals who are individual taxpayers. The typical deadline is April 15th. That has now been moved to July 15th because of the hardships that this coronavirus is causing taxpayers. The Secretary of the Treasury has decided to move the April 15th deadline to July 15th. What does it mean for IRAs? Whereas the individual typically has the tax return due date of April 15th to make that contribution, and as well as file their tax return, of course, you cannot use an extension to extend further when you're going to make an IRA contribution. It is due by April 15th, no extensions. That has now been extended to July 15th. Now, keep in mind, if you apply for an extension, you still do not get that extension to make a contribution. This is just an extension from April 15th to July 15th of that April 15th deadline to make a contribution, but you cannot extend that any further. So if an individual is wanting to make a contribution to an IRA, you can make it as far as July 15th for 2020. Now, if you apply for an extension, now keep in mind, typically the IRS provides a 6-month extension. That 6-month extension is typically October 15th, 6 months from April 15th. However, the Treasury Department does not extend that 6-month extension. So if you apply for an extension on your July 15th deadline, your deadline will still be October 15th. Now, that might sound a little bit confusing, but that's where you come in. Right? Jot down any questions you may have, and I'll be more than happy to answer the questions for you later on. In a nutshell, again, the April 15th deadline to file an individual's tax return has been extended to July 15th, which means that the IRA contributions can be made up until July 15th. If you apply for an extension, that does not extend your deadline to make an IRA contribution. Now, what are the tax benefits of making an IRA contribution? Now, keep in mind, when you're dealing with an IRA contribution, you might be saying, well, I don't need to make an IRA contribution for myself. Keep in mind, you have family members as well. As long as they have earned income, they can actually make a contribution. I tell individuals out there, some people have kids and they have part-time jobs. If they have part-time jobs, they have earned income. If they have earned income, nothing stops a parent or legal guardian to make a contribution on their behalf. As long as they have earned income, they're eligible to make a contribution. And some people say, why would you want to do that? Because by making a contribution of their IRA, if they have earned income, in other words, if they qualify, you just basically gave them an inheritance. For the most part, a lot of parents that do that don't tell their kids that they're making an IRA contribution on their behalf. That is what we call in the industry a minor account. In other words, the parent would set up an IRA on behalf of a minor, and when the minor reaches age of majority, in other words, their legal age, then they take over the IRA. Wouldn't it be nice to be able to give a savings account, which is growing tax deferred, a retirement savings account, to a child later on? And in some cases, as an example, in a Roth IRA, up to $10,000 of the earnings can be distributed tax-free to purchase their first home. Anyway, there's a lot to be said about making IRA contributions. So it's not just for you listening to this particular course. It is also available for other members that may have earned income. And if they don't have the money to contribute, the money does not have to come from their own pocket. It can come from anywhere. As long as they have earned income, they should be able to contribute to a type of IRA. Now, there are two different types of IRAs that an individual can contribute to every year. One of which is a traditional IRA, the other one is a Roth IRA. We're going to take a look at some of the differences of the two different types of IRAs later on. Now, what does the tax deadline mean again? The tax return due date of April 15th has been extended to July 15th. We've kind of beaten that thing to a pulp. The extension is limited. In other words, not only is the tax deadline extended to July 15th, the payment of taxes, if somebody owes taxes, has also been extended to July 15th of 2020. This extension applies to individuals that owe $1 million or less, which of course will hit pretty much the masses in the United States, as well as for corporations that owe $10 million or less. In other words, it gives a little bit of an extension for large company or companies that owe $10 million or less in taxes. What does the extension mean? It eliminates the interest paid that needs to be paid if paid by the deadline. In other words, it buys them a little bit of 3 months. But if they do file for an extension, again, that extension does not extend further than the typical deadline from the original tax return due date. What I mean by that is if your deadline is if the deadline was April 15th before, and you filed for an extension, which typically gives 6 months as an extension, and that falls on October 15th. Now, given the fact that it's been extended from April 15th to July 15th, does that mean you get an additional 6 months? The answer is no. October 15th is still the ultimate deadline if you file for an extension on July 15th. All right. The IRS does have an FAQ in regards to this tax extension deadline. So if you are interested in that, just Google it, www.irs.gov, tax extension deadline, and there is a frequently asked question portion of the IRS website devoted to this tax extension deadline. For those individuals who are listening to this webinar that have to file an IRS Form 990P for their IRAs, that extension, the extension does not apply to that particular tax return for your IRA. So that still has the same deadline. Okay. Overview of two different types of retirement accounts that I mentioned earlier. First one is what we call your traditional IRA. The traditional IRA typically has two benefits. One is a potential tax deduction. In other words, you can actually possibly use that contribution to reduce your taxable income. So in other words, if you make $100,000 a year, and let's say it's tax deductible, and you made a $7,000 contribution because you're 50 and over, then you'll only have to pay tax on $93,000. That's a simplistic way to give an example of how a tax deduction works. What does that mean? You save yourself some taxes, but not everybody can get that. We'll take a look at why not everybody can get that in a second. Now, there is no income limit to make a contribution. So in other words, you can make $1 billion and still make a contribution. The only question is your contribution tax deductible or not? The earnings do grow tax deferred. So in other words, if you have a $7,000 contribution and it earned 20%, well, that 20% is not going to get taxed until when? Until you distribute it, until you take it out, until you request, for example, from Entrust that you want to take money out of your retirement plan. Traditional IRA, and the other one is a Roth IRA. In a traditional IRA, again, there is no income limit to making an annual contribution. The individual could possibly get what we call a potential tax deduction. In other words, not everybody can get the tax deduction. Earnings do grow tax deferred, but eventually the earnings on that account, as well as the contributions that have been used as a tax deduction, will be distributed and will be taxed at the rate during the year in which the distribution takes place. There is no contribution age limit beginning for 2020. However, if you are as well as in a traditional IRA, when a person reaches age 72, they're going to have to start to take what we call required minimum distributions. In a Roth IRA, there are income limits. In other words, you cannot be rich, and we'll define that later on what defines who is rich. Earnings grow tax deferred, and earnings eventually could be distributed tax-free. When is it distributed tax-free? It's distributed tax-free if an individual has had a Roth for 5 years. In other words, the moment you make a contribution, the clock starts ticking as of January 1st of the year for which a contribution is made. So in other words, somebody makes a contribution today and designates that contribution for 2019. Well, the clock started ticking January 1st of 2019. That's one half of the requirement. The only requirement that they're going to be needing to attain in order for the earnings to be tax-free are one of the four. Once a person reaches the age of 59 and a half and 5 years, all of the Roth IRAs are tax-free for the rest of their lives. Number two, if you die, you don't want that to happen, but if you die and you've had a Roth for 5 years, your beneficiaries will enjoy your Roth IRA that they have inherited tax-free. And last but not least, if you become disabled, then the distribution out of your Roth, all of your Roth, is tax-free. There's only one additional stipulation, which I mentioned already earlier, that if you're taking a distribution to purchase a first-time home, up to $10,000 of the earnings will be distributed tax-free. Now, why only the earnings? Because the contributions are not used as a tax deduction, therefore would have been viewed as having been taxed already. So you can take those out at any time. When we're talking about tax-free, it's only the earnings in a Roth that needs to satisfy that requirement. If you have had a Roth for 5 years and one of the four, 59 and a half, death, disability, and up to $10,000 of the earnings for a first-time home, those earnings will be distributed tax-free. There is no age limit to make a contribution on a Roth, and there are no required minimum distributions while an individual is alive. In other words, required minimum distributions or amounts that are required to be distributed from an IRA is not going to be required until the person passes away. So in other words, the beneficiaries are the only ones that will have what we call required minimum distributions. But if an individual is age 76, as an example, there's nothing required to be distributed out of Roth. Significant differences between the two different types of IRAs. One is a traditional again, and the other one is a Roth IRA. Now, who can contribute to a traditional IRA? For 2019, the individual must be under the age of 70 and a half. What does that mean? If you turn 70 and a half in 2019, then you can no longer make a contribution for 2019. But if you're going to make a contribution for 2020, where the rules have changed because of the Secure Act, well, if you're making a contribution in 2020, there's no more age limit. That has been removed under the Secure Act, which was passed effective for 2020. The individual must still have taxable compensation. Another term for that is what we call earned income. In other words, you must have wages for services performed. In other words, those wages must be subject to Social Security tax in order for that income to support the contribution. The maximum contribution is the lesser of your earned income or a statutory limit, which we'll mention in a second. So in other words, if the statutory limit is $7,000 for you or $6,000 for you, if you're under the age of 50 and your earned income is only $2,000, well, guess what? You can only make up to $2,000 contribution, even though your taxable income may be $150,000 because you have other sources of income such as dividends, interest, pensions, whatever it may be. Those don't count. It's only the earned income that counts for making a contribution. Wages for services performed. A good example of that is what we call a W-2 wage, right? Now, contributions are not limited to just the individual. If they're married and they file a joint tax return, even if the other individual does not have enough earned income, as long as their combined total income supports making a contribution to each individual's IRA, well, then each individual can make up to the maximum, assuming, of course, or lesser of their earned income. If their earned income is smaller than the statutory limit, then that's their maximum. But if they have more than enough income to support the maximum contribution for each individual's IRA, well, then they can make the full contribution in each of the individual's IRAs for contribution purposes. If you have any questions, please don't hesitate to jot those down, and we want to answer those questions. Right. Here's an example of taxable compensation. You can actually find this chart on the IRS publication 590. Publication 590. What is considered taxable compensation? Wages, salaries, professional fees, commissions, and bonuses. Self-employment income, assuming, of course, it's positive. Alimony or separate maintenance. In other words, if the alimony that the individual is receiving is going to be taxable to them, then that's going to be considered earned income. Now, if the individual paying the alimony paid taxes on the amount prior to paying it, well, then that cannot be considered as earned income. Military differential pay, non-taxable combat pay. So if you have somebody in the military and they are earning income during combat, which is typically non-taxable, that is now considered earned income under the HEROES Act. Taxable non-tuition and stipend. In other words, individuals who are receiving a stipend, say they're going to graduate school, and typically it's taxable to them if they don't use it for educational purposes. Well, guess what? That's considered earned income moving forward under the Secure Act. And last but not least, difficulty of care payments. In other words, if generally 131 talks about foster care. If income is received for foster care, generally foster care, talk to your tax advisor about difficulty of care payments. That income may now be considered as earned income. What is not considered earned income or taxable compensation? Earnings and profits from rental properties, interest and dividends, pension or annuities, deferred compensation, income from certain partnerships that are considered passive income, and last but not least, self-employment loss. A loss cannot be considered as earning income to support a contribution. If you didn't make any money off of it, then you don't have any earnings. All right. How much can be contributed? It's the lesser of your earned income or $6,000 for 2019 as well as 2020. In other words, you can make a $6,000 contribution if you're eligible for 2019 as well as 2020, assuming, of course, that you have enough earned income. If you're 50 and older, then you can make an additional $1,000 contribution for each one of those years. And 50 and older means if you're going to have a birthday for a particular year and you're going to turn 50, you're already eligible for that additional $1,000. This limit is shared by both a traditional and a Roth IRA. So whatever contribution you make in a traditional, that reduces the amounts that you can contribute to a Roth. In other words, if you're under the age of 50 and your maximum contribution is $6,000 and you contributed $3,000 to a traditional already, well, that limits you to $3,000 to a Roth. In other words, you can contribute to both types of IRAs in any variations of amounts, as long as the combined amounts provided or contributed to each one of those IRAs in total does not exceed whatever that limit is. Annual contributions must be in cash. So you cannot contribute gold or stocks, bonds. It has to be in cash. You can write a check, you can ACH it, you can wire it, but it has to be done in cash, right? Maximum amounts only applies to contributions, annual contributions. It does not apply to rollovers, transfers from existing balances within other retirement plans. This is just your maximum annual contributions to your IRA. Traditional IRA deductibility is another question a lot of people have. In other words, is my contribution tax deductible? Those people that are asking that question must answer this question first. Are you covered by an employer-sponsored plan? That question right there will tell you whether or not you have to pay close attention to the amount of income you made for the year to determine deductibility. Because if you're not covered by an employer-sponsored plan and your spouse is not covered by an employer-sponsored plan if you're married, well, then this rule does not apply. In other words, if you or your spouse is not covered by an employer-sponsored plan, you can make a fully deductible contribution regardless of how much you made. But if you are covered by an employer-sponsored plan, what does it mean covered? If $1 is contributed on behalf of your account in an employer-sponsored plan, whether it be your own contribution or the employer's contribution, you're covered. The way to to determine that is in your W-2. If you receive a W-2 and there's a pension plan checkbox in a W-2, if that's checked, you're covered. If it's not checked, then you're not covered. If you are covered, then you need to pay close attention to your modified adjusted gross income to determine whether or not your contribution to an IRA is deductible or not. Why is this important? Because if you can't deduct the contribution, you might as well consider what? A Roth IRA. Because a Roth IRA, contributions are not deductible. But if you're not eligible to contribute to a Roth IRA, you can still make a contribution to a traditional IRA called a non-deductible contribution. In other words, if you're not going to use it as a tax deduction, it's going to be viewed as if you're paying taxes on the contribution that you're making to a traditional. Now, why would you want to do that? Because the earnings on that contribution will still grow tax deferred. All right. So some people may make a non-deductible contribution to the traditional IRA. Now, another question is, if you're going to pay taxes on the contribution being made to a traditional IRA, do you think you might want to keep track of it? The answer is absolutely. Because if you don't keep track of it, when you take that distribution and you didn't track it, guess what's going to happen? It's going to get taxed again. There's an IRS form that a taxpayer must file. It's the IRS form 8606. The IRS form 8606 reports any non-deductible contributions made to a traditional IRA in the year of contribution. And that has to be added to any non-deductible contributions that you made in the past. Why is that? Because if you've made contributions in the past called non-deductible contributions, you may want to track those so that upon distribution, you won't get taxed again. But if you didn't track it, that distribution may essentially be taxed again because of the lack of record keeping of those non-deductible contributions. What determines whether or not a contribution is deductible or not? If you're covered by an employer-sponsored plan, and 2, depending upon your income. For 2019, let's take a look at an example. We'll take a look at the single and active participant. For 2019, the income limits are 64 to 74. How does that work? If the modified adjusted gross income of an individual is below $64,000 for 2019, not only can they make a contribution if they're covered by an employer-sponsored plan, they can also fully deduct their contribution. But if their income falls above 64, it starts to reduce the amount of contribution that they can deduct. It's typically 10% for every 1,000 that goes over 64. So in other words, if the maximum contribution for an individual is $6,000 for the year because they're under age 50, and they make $65,000 of modified adjusted gross income for the year, that reduces the $6,000 by 10%. In other words, they can only make a $5,400 deductible contribution. What would be the best place to put the other $600 or 10%? Well, they may be better off putting that in a Roth. Right? The higher the income, the less opportunity for deduction this individual gets. If it's over 74, no deduction is allowed at all. You can still make the contribution, it just won't be deductible. And that's where the IRS Form 8606 comes into play. Right? For 2020, for a single, it's $65,000 to $75,000. For a married couple filing a joint tax return, the phase-out range for 2019 is 103 to 123. In this particular example, it's for every 1,000 that goes over, as an example, 103, it reduces their deductibility by 5%. And the higher income they go, well, then the less chance they'll have for deductions. Whatever they can't deduct, might as well consider a Roth. That's why we're talking about traditionals and Roths. For a married couple filing a separate return, it is almost impossible to get a tax deduction. Why is that? Because they're already getting a tax break by filing a separate return. In other words, to lower the tax liability for the married couple, they're filing a separate return. What about an individual who is not covered but is married to someone? Well, the person who is not covered but is married to someone, their phase-out range is a lot higher. In other words, it's 193 to 203 for 2019, 196 to 206. So in other words, if you, let's say you have a married couple filing a joint tax return, one of them is covered. Well, the covered one, to determine their own contribution, whether or not it's deductible or not, the 103 to 123 for 2019 applies. But if the other one who is not covered but is married to one who is covered also makes a contribution, then their phase-out range for the one who is married to someone who is covered is 193 to 203,000. So in other words, you need to know what modified adjusted gross income number is applied to each individual to determine deductibility. So for all intents and purposes, in a nutshell, if you're going to make a traditional IRA contribution to determine whether or not your contribution is deductible or not, first question is, are you covered by an employer-sponsored plan? And if you are covered by an employer-sponsored plan, what we're looking at here are those income limits or income levels that will determine whether or not your contribution is deductible or not. Okay. All right, go to the next slide. In a Roth IRA, who can contribute? All right. There is no age limit on a Roth IRA. You can be 76 and make a contribution. However, you still must have earned income. In other words, you must have taxable compensation. There is, however, an income limit to make a Roth contribution. And we'll take a look at what those income limits are. Spousal contributions are also available for Roth IRAs. So in other words, if you have a married couple filing a joint tax return, one does not have enough earned income, it doesn't matter. They can use your combined income for the year to determine whether or not they can make a contribution to it. Here are the income limits to make a Roth IRA contribution. All right. For a single filer, it's 122 to 137. Under 122, they can make a full Roth contribution. Between 122 and 137 for 2019, a partial Roth contribution, and over 137, they're not eligible for a Roth IRA at all. Right? For a married couple for 2019, it's between 193 and 203. Under 193, full Roth contribution. Between 193 and 203, partial Roth contribution. Over 203, not eligible for a Roth. For a married couple filing a separate return, again, it's almost impossible. There are worksheets that can be found on the back of the IRS Form 1040 instructions that may be useful for a taxpayer to determine the amount that they can contribute to a Roth using these particular numbers that we're showing you on the screen, which will help determine the amount eligible as a contribution for the particular year. So let's take a look at an example of a spousal contribution. We have Olga, who's 95, who has $95,000 of wages as a nurse in 2019 and 2020. Ernest, Olga's husband, is retired at age 65. Olga is under the age of 50. Based on what we looked at already, what type of IRAs can Olga contribute to? Well, of course, Olga can contribute to a traditional and or a Roth IRA of $6,000. Or, in other words, you can contribute to either or both, as long as the combined amounts contributed does not exceed that $6,000. Why $6,000? Because she's under the age of 50. Ernest, who may not have earned income, but is married to Olga, and let's say they're a married couple filing a joint tax return, and in our example they are, well, then Ernest can also make a contribution. But Ernest's contribution limit is a lot higher, $7,000. Why is that? Because Ernest is above 50 years old. So therefore, he can make an additional $1,000 above and beyond what Olga can make. So Ernest can open up his traditional or Roth or both and contribute maximum $7,000. Olga can also set up her traditional and or Roth and make a total of $6,000 contribution. They have to establish their own IRAs in this particular case, and up to 4 if they want to contribute to both a traditional and Roth. Traditional and Roth for Olga, traditional and Roth for Ernest, and only for maximum again for is $6,000 and for Ernest $7,000. The maximum contribution for a Roth IRA is $6,000, as mentioned earlier. $6,000 is for a person under the age of 50. $7,000 is for an individual age 50 and older. Again, any amounts contributed to another type of IRA reduces whatever you can contribute to a Roth. Same as traditionals, contributions must be made in cash, and the maximum contribution does not apply to other types of amounts coming into an IRA, such as rollovers, transfers, so on and so forth. This is just your annual contribution limit for the year, right? Here's another chart that shows it. Up to age of 50 is 6,000, but 50 plus an additional 1,000, so on and so forth. The deadline again to make a contribution is April 15th. However, with the extension that Secretary Mnuchin just issued to the Treasury Department, April 15th, and only for 2020, has been extended to July 15th, an additional 90 days. In other words, instead of rushing right now to file your tax returns April 15th, which is coming up, there's been an extension for that deadline to only for tax year 2020 to July. Here are some key tax documents that you might want to look for this year to file your tax return. If you've ever taken a distribution of $10 or more from a retirement plan, you will get what we call an IRS Form 1099-R. The 1099-R would disclose the amount that you took as a distribution. That is includable as taxable income in the year of the distribution. Distributions may also be subject to an additional 10% penalty if a person is under the age of 59 and a half and not eligible for one of the penalty exceptions. So not only will you be subject to tax, you will also be subject to a penalty. Now, the penalty is paid using what we call an IRS Form 5329. But the tax is reported on the individual's IRS Form 1040, and I believe it's line 4 of the IRS Form 1040. Now, a lot of questions that we receive, which is not on your slide, is, do I have to file the 1099-R with my IRS Form 1040? The answer is, it depends. It depends upon whether or not you had any amounts withheld from that distribution. When you're taking a distribution from an IRA, the typical withholding, the mandatory withholding, is 10% of the distribution. For $1,000, as an example, $100 will be withheld at Uncle Sam. Now, is that enough to pay the tax? The answer is we don't know, because we don't know what bracket you're in. You may be in the 12% bracket or the 22% bracket. But the IRS mandates the payer, the financial institution, to withhold at least 10%, unless the individual waives out of it. If withholding is taken out of a distribution, then the 1099-R must be filed with the individual's tax return to show the IRS the amount that was withheld from that distribution as a prepayment of taxes for that distribution. Without that 1099-R showing that amount withheld, and I believe it's on box 4 of that 1099-R, you have no proof that an amount was already withheld from your distribution to prove that, you paid a portion of the tax on that already, right? So 1099-R does not always necessarily have to be filed with your tax return. However, if you have withholding, you might want to include that in your tax return when you file your. The IRS Form 5498 is received every year that reports not only the fair market value, but if you do have contributions that you've made by your tax return due date, well, then that should be reported on the 5498. Box 1 will report the contribution to a traditional, and box 10, a separate 5498 on box 10, will report your Roth contribution, right? Box 1, traditional, box 10, your Roth. And if there's a SEP contribution made, if you have an employer-sponsored plan, that's box 8. And if you are a simple if you're an employer that offers a simple IRA plan, then that will be on box 9 of the IRS Form 5498. The 5498 proves that a contribution has been made. So if you're going to use a contribution as a tax deduction, well, there better be something that shows up on box 1 of the IRS Form 5498. Now, this is typically due by May 31st of the following tax years. In other words, for 2019, typically May 31st is the deadline on when the 5498 is produced. However, keep in mind again, the tax return due date has been extended to July 15th. However, currently, we do not have any indication from the Treasury Department on the extension of when the 5498 is going to be due, given the fact that they've extended the tax return due date to July 15th. They hopefully would extend the 5498 deadline as well to coincide with the extension of the tax return due date, because that reports your contributions made for 2019. All right, enough said. Again, if you have any questions, jot those down. I'd be more than happy to answer the questions you may have in regards to the material presented. IRS Form 8606. The IRS Form 8606 keeps track of contributions that have been made called non-deductible contributions. All right. So if you make a non-deductible contribution to a traditional IRA, Part 1 of the IRS Form 8606. If you took a distribution out of an IRA that contained non-deductible contributions, the IRS Form 8606 is also the means of reporting to the IRS. IRS, portion of this distribution is not taxable because I've already paid taxes on it already, IRS Form 8606. If an individual conducted a conversion, in other words, you take the distribution out of your traditional IRA to convert that to a Roth IRA, that's Part 2 of the IRS Form 8606 that keeps track of those dollars that have been taxed already, called conversion basis and Roth. Lastly, if an individual takes a distribution from a Roth IRA and it has not been 5 years and one of the four, in other words, you're not 59 and a half, you're not dead, you're not disabled, and you're not using it for a first-time home, as well as you haven't had a Roth for 5 years, well, the distribution on that works in what we call the ordering rules. Contributions come out first, conversion dollars come out second, and last but not least, earnings are the last things to come out of a Roth IRA. How is that all determined? The IRS Form 8606, Part 3. Here's some of the key documents. IRS Form 1040 for taxpayers. You know, if that's your individual tax return. If you have an IRA that has what we call unrelated business income tax, or unrelated business taxable income, some may call it that way, then the IRS Form 990T is typically due by the end of 4.5 months after the end of the tax year. So that's coming up as well. That 990T does not get an extension at this point. There's no extensions for that. And last but not least, if you're making a contribution to an IRA, you or family members making a contribution to an IRA, and they can use that contribution to determine what we call a tax saver's credit. That the form that's used for that is what we call the IRS Form 8880. This is only available for individuals that fall within a certain level of income. They're saying, I can barely survive, let alone contribute to a retirement plan. Uncle Sam says, let me meet you halfway. Let me reduce the amount of tax you'll have to pay, so therefore at this point, you'll have money to contribute if you contribute to a retirement plan. That is available again for individuals that fall below a certain income threshold. And we'll take a look at how that works later on. Here are some key publications to read. If you want to read up more about what we're talking about here, for IRAs, it's publication 590A, right? Publication 17 provides the federal income tax tables. Publication 575 discusses tax treatment of distributions from pensions and annuities. And last but not least, if you are interested in small business plans, there's what we call the publication 560. If you're an entrepreneur and you did well in 2019, you want to shelter some of your cash, it is not too late to establish an employer-sponsored plan for 2019 called a SEP plan. A SEP plan is a profit-sharing plan that can be established up until your tax return due date plus extensions, which means you can defer up to 25% of your adjusted net business income into a retirement plan and reduce the amount of tax liability you have for the year. That contribution goes into what we call a SEP IRA, also known as a traditional IRA. Tips to reduce your taxable income for the year. If you're over 70 and a half, you can make a qualified charitable distribution. And if that's, if you had an RMD due from previous years, well, that amount counts towards your RMD. And that amount is not going to be taxable to you if you're eligible to make a qualified charitable distribution. If you're covered by a high deductible health plan, you can make a health savings account contribution. That is a straight line deduction on your IRS Form 1040. If you are an entrepreneur, in other words, a small business, and you want to contribute to a small business plan, that'll also reduce your taxable income for the year. If you establish a set plan for 2019 as an example. And last but not least, you can make the maximum traditional IRA contribution. If you're eligible for a deduction, that can reduce your taxable income for the year. We kind of walk you through that already. And last but not least, the tax savers. How does that work? This is only available to individuals who have a lower adjusted gross income. It is non-refundable. The maximum tax credit is $1,000 per taxpayer. In other words, if you have a husband and wife, or wife-wife, or husband-husband, then $1,000 for each individual could be availed of if they qualify for it, and reduce the amount of tax that they owe. The IRS form that is used to do that is what we call the IRS Form 8880, right? The individual must be age 18 before the end of the calendar year. They cannot be claimed as a dependent. They cannot be a full-time student. I don't like that rule, but that's the way they wrote the rules. Why don't I like that rule? How many people do you know out there are full-time that are also working full-time? They should be rewarded for that, commended for that. But they exclude them from being able to avail of the tax credit. And last but not least, they have to fall within a certain adjusted gross income. If you fall below a certain adjusted income, you can use up to a certain percentage of your contributions made to a retirement plan. And that maximum amount is $2,000. A certain percentage of up to $2,000 to get your tax credit. And the maximum percentage is 50%. In other words, the lower your income, your adjusted gross income, well, then the higher chance you'll be able to get up to $1,000 of a tax credit. Don't lose out on that. Neither for you nor for your family members. If they're eligible for a tax credit, get some of that money, back from the Internal Revenue Service if you qualify for it. Well, that's enough said. I mean, I'm kind of gone to 12 o'clock further than what I expected to finish the presentation, but we're going to open up the phone lines in a second to answer any questions that you may have. To open up an Entrust account, we just need for you to fill out an application online. Of course, provide us your identification. You can fund your account by either a contribution, a transfer from another IRA of the same type, or rollover from an employer-sponsored plan. And last but not least, you can tell us to purchase whatever asset that you've vetted out and researched to be purchased under your retirement plan. All right. Now I'd like to open up the phone lines for any questions you may have in regards to the material presented. All right. First question. What's the income max for the 8880? What is the maximum income? Hang on a second. Let's take a look at it. There is a chart you can find on the IRS website that depicts the maximum income. Okay, for a married couple filing a joint tax return in 2019, the maximum income is $38,500. Does that mean they only made $38,500? That's not right, because let's say you make $50,000 or even $60,000 for the year, and you contribute to a 401k plan of $10,000. Well, that $50,000 will be reduced by $10,000, which is a part of determining your adjusted gross income. If you participate in a health insurance program, which some health insurance programs are quite substantial, that will also help reduce your income to determine your adjusted gross income. The maximum adjusted gross income that I mentioned for 2019 is adjusted. It's not your gross income, but it's your adjusted gross income. So in other words, after the adjustments, HSA contributions will also adjust your income. whatever's remaining, if it's 30, if it's 38,500 or less, well, then you are eligible for a tax savers credit. If it's more than 38,500 up to 41,500 for a married couple, then your tax credit is 20%. And then greater than 41,500 to 64,000 adjusted, then your tax credit is 10% of up to $2,000 contribution. I don't want to go through the whole chart, but if you Google tax savers credit chart for each one of the years, you'll be able to find that fairly quickly on what the tax savers credit amounts are. Well, I've gone over time because of the technical difficulties. I thank you again for attending today's webinar. And again, I apologize for the technical difficulties we experienced in the middle of the webinar. My name is Paul Ruiz, and look forward to having you again in another Entrust Group webinar. Have a great day.